All right, welcome to Rich Dad's Stockcast with Andy Tanner. And this week, as always, Andy Tanner is going to give us a free gift, so we'll get into that right away. But also, today we're going to talk about 5 reasons why the U.S. stocks will likely rally at the end of 2023. So you'll definitely want to get Andy's opinion on that and see if the article we've got in front of us with Market Watch is accurate, what he feels about it. But before, like I said, Andy has a free gift to give you. It's a free webinar called Zero to Cash Flow. It really teaches the Rich Dad philosophy of stocks. Would you say that's true, Andy?
Yeah, and what I like about this particular webinar is like if a person just is like starting, they've never even opened up a trading account. They've never done this before. They're starting at square one. And, I love all the asset classes. I never say that one's better than another because you can find billionaires in every asset class. One of the nice things about stock, however, is that if a person has read Rich Dad, Poor Dad, and they look at their asset column, there's nothing in there and they want to do something and get some cash flow. Well, I'm not going to say $0 to $1 million, but we can go 0 to some type of cash flow where it's kind of nice if someone wants to start and get something coming in other than the job. This is the fastest way I know of to do that. So fun.
Yeah. Fastest with, and you hate this, but I'm going to use it in one area, the lowest risk, because you can start without much money. So your risk is much lower while you learn. Is that fair?
I think that's fair. And you can also paper trade and practice with no risk. So
right.
Very cool.
There you have it. All right, let's dig into the 5 reasons. This is an article from Market Watch by Joseph Adenofi. Wow, maybe that might be his name. I'm not really sure. But you ready, Andy?
Yeah, it was interesting. Greg came across this article and he emailed it to me. I think it was yesterday or the day before. And I went through it, and it's really interesting to see how Wall Street and people that report think about it and how different I think about it. So we'll get into.
I want to, Andy versus Wall Street basically is how I see it. Yeah. So Andy, number one reason why the stock market's going to go up in 2023 is the Fed's tightening cycle is nearly done. So will you real quick tell us what he means by Fed's tightening cycle and why does he think it's done, and what do you think?
So if we, in a nutshell, we've had inflation. During COVID, they poured, $3-4 trillion they printed, and we've all felt that pain at the grocery store, at the gas pump. And so what the Fed has done is says, wow, we printed too much money. We got to make it harder to get. We got to make it more scarce. So what they do to make money harder to get, it doesn't eliminate the money, but it makes it harder to get, is you raise interest rates. And the way that works is the Fed might say, all right, we'll give you 5.25%. Well, there's no way that a bank is going to loan you money to buy a house that's risky that you could default on for less than 5.25% now, because they can put that money at the Fed risk-free. So that's how the Fed puts a floor on interest rates. Was they raise those rates? If you're looking at 5.25 at the Fed, you're looking at 6+ to get a mortgage. That's why they've done that. Well, what they're saying is, boy, we've really raised this. We think we might have control of inflation a little bit. Maybe we'll pull that off and make money easier to get. And that makes the stock market go up traditionally. I have 2 thoughts on that. Number one, it's really hard in the Fed right now to steer this ship, because if you remember when they started printing all the money, everyone says, oh, there's going to be inflation. So the same guy that wrote this might have said, oh, we're going to have a crash. We're going to have, inflation. Well, it took 18 months, 2 years before that happened. So to think that, oh, now they're going to stop, they're going to do one more rate hike, this week, they'll do one more rate hike, and then they think they'll level off. But that doesn't necessarily mean a boost to the stock market. It might take some time to see that in reality. And there's also a chance that inflation could resume, that they don't have control on it like they think. So do I think that's a good reason to think? Yeah, I think you don't fight the Fed. I think the Fed if they go ease, there's certainly a correlation between the market going up. But here's where you're going to hate me. Here's where you'll hate me. I don't care. I don't care. I don't care. Back in 2007, I started an education company, and in about 13 years ago, we changed our name to the Cash Flow Academy. We're not the Capital Gain Academy. We're not the Stock Up and Down Academy. We're not the I give a rat's you know what about where the stock market goes. Think of it this way: do I care? If I could just talk to the real estate folks for a minute, okay? I don't really watch Zillow every day. Zillow sends me these things. I have some syndications and I have some single family homes that I rent. And I get these notifications says, oh, you're up, 5%, down 5%, the home prices fluctuate. I don't care. I'm not selling it. I'm just getting rent. I want cash flow. So when someone, opens up Market Watch and says, oh, the market's going up, should I buy or sell? They're not even in my world. I mean, they're not even, I could care less. I don't care. Warren Buffett doesn't care. Charlie Munger doesn't care. So I had the rant came early, bud. Sorry.
You're good. You're all right. You want to know what's funny? Here's something that you're gonna find funny. The whole reason Sarah, our producer, wanted to give the free gift of 30 days to cash flow is she knew that rant was coming. She told me.
She had it predicted. Did she really? She goes, Andy's going to go nuts.
Yeah,
he can't stand capital gains.
Exactly.
Yeah, but if you are, one reason I might want to pay attention to this is you invest in stocks, but you do trade options, and so that would affect how I care possibly about the options a little bit because they're correlated. And there's so many strategies. You could sell some puts. If it dips down, then you get great bargains right now. If it takes off, just put that money in your pocket. So there's a lot of cool things you can do directionally. So I'm not going to poo-poo it entirely, but mostly it's just cash flow, man. Just why do I care where the dang market?
All right.
Anyway,
so I'm going to challenge you a little bit on this next one. What he's saying on this next one is that the lower interest rates support stocks, makes people more interested. More people get in. Isn't that actually, for someone like you who really focuses on dividends and infinite returns, especially infinite returns, isn't that a bad thing if more people get into the stocks and start spending more money? Doesn't that raise the prices?
Actually, it's great for me. I love it. I like the stock market to go up, and there's a couple reasons why. But let's talk about interest rates, though, for a little bit. Interest rates, when you look at paper assets, it's almost like there's asset classes within asset classes. So when you look at paper assets, you have bonds, which is loaning money, it's debt, and you have stocks, which is equity, which is ownership. So you can loan them money or you can buy a piece of the company. I like the second one better. I'd much rather own stuff than get loans. You got a better upside, more risk, but loans. Well, with the Fed going, jacking these interest rates up, think about this. If I want to do a corporate bond, I'm going to be higher than what the Fed offers because the Fed is quote unquote guaranteed risk free. They'll always pay it, right? And so right now, bonds can be more attractive than a dividend. You go back 2 years ago, you get a dividend of 4%. You're pretty excited. Well, now you can get a bond for 5 or 6. So the bond market will attract capital. That sucks money out of the stock market, which makes the stock market fall. So if all of a sudden interest rates drop, then people say, okay, I need yield. Let's go back into the stock market, and that should lift. So when he says low interest rates support stocks, what I think he's saying with that is, that's what he said, is that takes people say, well, I'm not going to put my money in bonds. There's not a lot of yield in that. I think I'll try my luck with stocks. The reason I like stocks going higher is, let's say I bought, like Coca-Cola, and I like Warren Buffett, I bought it at $3. Well, great. The dividend's fantastic, and I get a great return. But let's say I want to write a covered call. Well, the higher the price of the stock, the better premium I can get on a covered call or on an option. And so that my cash flow actually gets much, much higher the higher the stock goes. I didn't put any more money into it, but I get to write higher premiums, and I can write them further out of the money now if I want to, and be more conservative if I look at my return on my own, in return on investment rather than, yield at the current price. So I like stocks going up
Okay. Quick
when I
question.
own them.
You're right. This is just a Greg question, but it sounded like you almost made it so when dividends go up, the bond market goes down. So
Yeah.
is that accurate?
No, I mean, dividends are more a function of an individual company. That dividends don't really rise. You know, the Fed puts a floor on interest rates, loans, debt, right? So I can either loan money to the Fed, put it with the Fed, or I can loan money somewhere else. It's all loans. Dividends are different for every company. If I'm in a growth phase, I'm not paying a dividend. I'm going to reinvest for growth, right? Like Tesla's not going to pay a dividend. Apple didn't pay one for the longest time. So there's not really a correlation that if that dividends don't rise and fall like interest rates. It's like sea level, man. It's like the tide coming in and out. All the ships rise, all the ships drop. Dividends are more company specific.
Okay. Okay, that makes sense.
Yep.
Hey Andy, I'm gonna ask this one to you, and then you're gonna probably want
You're
to
gonna
kill
have a
me.
break.
So
Oh, okay.
we're gonna go on a break, but what I'm gonna ask you is, I think the stock prices are gonna go down, is what he's saying, and so there's gonna be bargain prices. So I want to get your thought on that right when we get back, because if stocks are down,
Okay.
it sounds like everyone should be buying, and I just wanted to see your
Yeah.
thoughts on that. So we'll go to break, and then we'll come right back to hear your
Okay.
thoughts on it. All right, we're back. We're back with Andy Tanner, the rich dad wealth expert, but also quite possibly the most generous man ever. And I say that because if you go into the descriptions, you can get free access to Andy's webinar called Zero to Cash Flow.
If I die, I want Greg to speak because the superlatives, the greatest, the biggest. I'm telling you, you'd probably be the only one that showed. So I guess you would be speaking.
Yeah, highly doubted. Robert Kiyosaki, he's probably cash flow king, but I think that makes you the cash flow prince, because no matter what I say, you go back to the importance of cash flow. So let's see if you can do that
Always.
here. Then you go to cash
Okay.
flow. It says the market is not appreciating the strong earnings, which sounds to me like the market is undervaluing, and once they realize they're going to go up in price. Does that sound right?
Yeah. There's what I call sometimes there's a detachment between, how well a company's doing and the frenzy and emotion of the market and the fears of the market, right? And that's where you find diamonds in the rough. And I actually agree with him on this. I've been very surprised, frankly, that some companies have missed earnings. We had a mixed bag this last week. Google fell short pretty bad, but other companies were pretty strong and kind of a mixed bag of earnings. But yeah, I do think there's some bargains out there based on how the companies are actually performing. So yeah, that can support stock prices. And I think that one of the things, in my weekly mentor club that we do for our students, we talked about the idea of actually selling puts at this time. The market has had a bit of a pullback in the short term. It fell below its 200-day moving average for a bit. And when it gets that far that fast, it usually people are like, wow, this is pretty cheap. It's very difficult for the stock market to go down because, in big crashes. That's why it doesn't happen very often, because there needs to be a big catalyst and a big panic. Because if there's no catalyst, and there's no big panic, and the market slides a bit, people are like, wow, they look at it on sale. They look at it like a bargain. They're like, wow, this might be the last time I get a chance. Like, I'll give you an example. Ford had a terrible drop. Ford's like, $7 now or something like that. $7, $9 probably. It's probably $9. So, if you could buy the best selling truck in America and buy their stock at $9, well, let's say I buy, Apple at 170 and it goes down $9. I've still got a lot ways to go. I buy Ford, that thing's got to go bankrupt to lose that $9.
Right.
So there's certain support levels like that where people are like, man, am I ever going to get a chance to buy an American company like that for that low again? fundamentals be damned. I just don't think they're going out of business. We're going to buy that. So selling puts to acquire stock right now, I have to agree with them. I think there are some good earnings, and I think there are some stocks that are mispriced. I do. I think
Okay.
there's some value there.
So I have two questions for you. I believe you said you use puts in a way to buy stocks even at a greater discount. But then
Yeah.
you've always told me, in fact, I think you even had a rant on the show once, that prices don't matter. So you want to explain that while we're talking about stocks
Yeah.
on sale?
Prices don't really matter after you buy them. If I were to look at a consumer, let's say I go out and buy this shirt, and it's $250 or whatever it was. After I buy it, I'm not really thinking about the price of the shirt anymore. It's mine. I'm going to keep it. I'm not going to sell it. I'm not looking to, put it out on wherever you put the clothes out on, the vintage stuff. So I don't think of it this way. If you're going to buy a goose that laid the golden egg, someone said I had to make a reference to that every time. Did we get there?
Yep. You're
So
there.
if you buy the goose that laid the golden egg, are you really saying, I think I'm going to buy it so I can sell it next week? You really buy it and you just kind of, you think, okay, I got a good price for it today. I bought it. Now, how long will it take those eggs to get me my money back, called rate of return? How fast will that happen? So I do think price is important when you buy, but after you buy it, it's a cash flow issue. So if you say, Andy, can you really turn that into a cash flow issue? Not only can I would.
Right.
Price is important when I buy, but after that, ideally I would never think, in an ideal world, I never think about it again. Why do I want to bring assets into my asset column, or do I want to get rid of them? I think I just want to keep buying more and 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 buying more. The only time I would sell it is if all of a sudden the goose quit laying golden eggs. I'm like, this is a lousy goose. I think I'll get what I can out of it and get rid of it, and sell that goose, and then someone, their goose will be cooked. So there you go. I don't know. That was a stretch.
No, you're fine. You're fine. Okay, this one is something I've done in real estate. I've tried to time the market.
Yeah.
Complete failure, by the way. So the fourth one here is seasonal trends look favorable. It sounds to me like that's a timing of the market.
Yeah, it is. It's kind of like the Farmer's Almanac. It's time for planting. But even in the Farmer's Almanac, there's variances. If you look at historical weather data, you'll find that the all-time high is like pretty hot, and the all-time low is pretty cold. Even in San Diego, you can have things that we call unseasonably warm, unseasonably cold. So even with the stock market, you have what's called a Santa Claus rally. You have kind of a September, October bear. Those are kind of bearish months, and then it kind of tends to rise out of that with Christmas shopping and all that type of stuff. Some of the guys on my team, like Noah Davidson, he follows seasonality and trusts a little bit more than I do. Do I put a lot of stock in that? Seasonality, there's so many other factors that, like, let's say that coronavirus comes out. We say, well, the market should probably go up because it's season to go up. Well, it doesn't matter what freaking season you're in.
Right.
It's going down if you have a pandemic, right? Oh, the Fed did something nutty. Well, but the almanac says. So, if I look at the almanac to go plant, but there's a volcano blowing lava into the air, I'm probably not planting right now. So seasonality, what we do when we write, and this is not a terrible critique of our our news reporter, but I think it's a fair one, is he's saying, I think the market's going up. So he's got to have 5 things to talk about. So he's trying to make his case. And if I said, all right, give me 5 reasons why it wouldn't go up, he could probably find them.
Right, sure.
So when you read the news like that, when a guy says, I think the market's going up, and now he's going to find reasons, that's kind of a rhetorical context more than a veridical one. He's probably less looking for the truth and more looking to support his, other things. And maybe he says, I think there's a preponderance of factors upwards, because I can certainly name some things that could go downwards. For example, Have we really got a budget together? Have we really got a Congress that's together? Do we have fiscal responsibility all of a sudden? Or do we have what happens with the Middle East if that thing gets worse, or even Ukraine? And what happens when China invades Taiwan and starts having problems there? What happens when there's election problems? I can bring in so much uncertainty into this. You can make a case for the downside too. The smartest thing, I think, is through ups and downs, and I don't like to sound like a broken record, but the smartest thing a person can do is get assets. If you read the book Rich Dad Poor Dad, wealth is about accumulating assets, and that hunting season's open year round. That's a season that's open all the time. Yeah, do I care about the big tide of the market? I guess. But I'm really more interested, like Buffett is going to find really great businesses that are undervalued. I'm going to use 4 pillars. Fundamentals is a good business. Technically, is the price at a good bargain? How am I going to cash flow this? And how am I going to manage my risk? And if I do those things, I think that's a key for all seasons. I saw his little chart. Where he took the aggregate, of all these years. He took the aggregate, showed it went up, and that's true. But if you look at each of those individuals, that there's some that went down too. So I think seasonality is cute, but I don't make decisions on seasonality.
Now, real quick, in the 4 pillars, you do teach technical trading, and that is kind of a seasonality.
Yeah, strategy. I do. It's not. No, technicals aren't seasonality. I mean, technicals is really more what's actually happening today. It's a measurement of momentum and price action and how people feel. Seasonality is like the almanac. Oh, it's September. Oil's going to go up in the summer and they'll die down. Then it'll go up again with heating oil. That's more the seasonality of it. Christmas, that's a season. But technical analysis is important. You absolutely, in my opinion, want to have a portion of businesses that you own. Don't be a stock picker. Be a business owner. Really big difference. Don't be a stock picker thinking that you're going to pick stocks and get some movement. Be a business owner. That's your core. That's your long-term core. Now, if I want to supplement those dividends, I want to supplement that, rent that I get, that cash flow that comes, I'm gonna own options and sell options and mess with options. No one has ever invested in an option, ever. They always trade them. And here's why. Options expire. They're not like a company that could last forever. There's no option that can last forever. And most of them, if you're going to sell them, you want to sell 6 weeks or less because time goes way quick.
Right.
For that reason, technical analysis is very important to me, because if I'm going to make a promise to somebody, sell an option, well, that promise, it matters where that goes. So I do care about technical analysis, but here's what's important to understand. I care more about ranges than direction. Everyone think about that that's watching. That's a huge nugget you could take from this. Is this article we're studying about is about making things go up or down. Is the market going up? Here's 5 reasons up, 5 reasons down, up, down. Well, you can actually, with some education, learn how to trade a range and make money. That's my favorite, because I can't tell you if Apple's going up tomorrow or down tomorrow. I'll tell you what, Apple's not going to 200 a share tomorrow, and it's not dropping to 140 either. And if I can make that bet and get paid for saying, I think it stays in this range, bam, your money. And that's really more how I care about technical analysis, is saying, I think it'll stay, below this number, or I think it'll stay above this number. But I'm less concerned about trying to do directional stuff, because I'm not as good at it as some guys, and it's just hard to predict the future.
Right.
All right. Here's one thought we can wrap with, and this is my counsel. One more question
for you too.
Oh, okay. All right. Go ahead, and then I'll wrap with it.
Then I'll let you wrap, because I didn't want to skip this one, because I believe this is a Warren Buffett, even a Robert Kiyosaki strategy. So I want to see if we got that right, because if it is, I'd really like to know. Okay. But he says, bearish sentiment is often a bullish indicator. Is he saying you always want to be doing what the opposite of what the crowd's doing?
I think you can often. I'm not a contrarian just to be a contrarian, but Warren Buffett did say this, and this sounds contrarian. I think it's a quote I have on my wall in my home office. He said this. He said, "I will tell you how to become rich. Close the doors." He says, "Be greedy when people are fearful, and be fearful when people are greedy." So when the market drops, people are fearful. That means there's a lot of us that are going to be greedy. Some people, consumers like Black Friday, investors like Black Swan, right? We like those prices dropping. So I would say, yes, that is a way that Warren Buffett thinks. I'm not going to put words in his mouth or in Robert Kiyosaki's mouth, but from what I've heard come out of their mouth, yeah, absolutely. Like in 2007, when everyone was selling and it was just dying, Robert and Kenny were buying, and Kim, they were buying. It was a sale, and they became very wealthy, wealthier, I should say, because they were buying things. In COVID was the best year I ever had in my life, in business, every area. COVID was the best year I ever had because everything was cheap.
Right. And Robert always tells a story, getting back to when people get in, it's time to get out. He tells a story where he's at the grocery store and the cashier hands him a business card and she says, "Hey, I'm a real estate agent now too. So let me know if you need to buy anything." And at that point he said,
"Oh, baby.
Yeah, okay,
Time
now
to get out.
Everybody's in. Yeah, I got to get out." So
time to get out. Absolutely true.
We are near the end, and you promised us a nugget of gold and a little bit of a summary here.
Yeah, I can't remember what I was going to say now, but that's no. What I would say is this: when you look at a media and you look at the news, you want to do so with a lens that's really filtered, with what they're saying. You want to really keep true to your principles and let the media kind of be the media. When you look at these articles, it's tough to take advice from a guy that writes articles. Buy assets. Learn to buy assets. Really important. So, with that, go buy assets.
All right.
Hey, check out that webinar. That's really a fun webinar I've done. Zero to cash flow. You'll kind of get a better sense of what we mean by this stuff. Of instead of the capital gain idea, cash flow idea. It's great stuff. You can get an asset and get going and start getting a little cash flow in your life. Right.
Well, and you talked about puts and small strategies, and that's covered really well in your 30 days.
Yeah, we do. I actually go through some great examples of that for people that would like to know how that works.
Well, great. I always say you're generous, so thank you for the gift.
Okay.
We'll see you next week.
All right.
Thanks, Andy.
Podcast is a presentation of Rich Dad Media Network.